So it is now my honor and privilege to introduce Fabio Panetta, who is a member of the Executive Board of the European Central Bank, who will share his views on crypto with us. Fabio, the stage is yours. There's a clicker here.
Good afternoon, everybody. It's a great pleasure to be here. We heard from previous speakers discussions on Terra, Luna. Luna is the Italian name for moon. And I think that in continuation with those comments, I will present you the dark side of the moon. So a different view from the very enthusiastic comments we heard until now. And before I start, however, let me mention that it is a true pleasure to be here, to be back at the London Business School. I did my PhD here a few years, many years, more than 35 years ago. And as soon as I still remember the day I arrived, and I was shocked by the friendly atmosphere that I found at LBS. I was previously at the London School of Economics, but then I decided I want to do a PhD in finance. And if you want to do a PhD in finance, you have to come to the London Business School then, and I guess now. And I remember that in those years, I learned how to do rigorous research, but above all, I learned the importance of doing one's job with enthusiasm. I still have vivid memories of those days, the discussions with my fellow students, many of which are still good friends, and above all, I have a great memory of discussions with the faculty, and I'm very grateful to my dear friend Steve Schaeffer, and especially to my very dear friend and then thesis supervisor Richard Brealey. Oh, thank you, Dick. The presentation today will be a summary, an abridged version of a broader analysis that you can find on the website of the ECB. Not that I want to do an advert for the ECB, but there are a number of statements that I will do today which are much better documented in my longer piece on the website of the ECB, and you will find numbers, references to, I believe, serious research on these topics. Now, moving from the past to the future. Today I will discuss crypto assets and the destiny of digital finance. Don't be scared. Don't be scared. So when I last spoke about crypto finance, I likened it to the Wild West. And I warned about the risks stemming from irrational exuberance among investors, negative externalities, and the lack of regulation. Crypto markets have since witnessed a number of bankruptcies. The crypto dominoes are falling, sending shockwaves through the entire crypto universe. The crash of stablecoin Terra USD and the recent bankruptcy of the crypto exchange FTX and 130 affiliated companies each took only a few days to unfold. This is not just a bubble that is bursting. It is like froth, multiple bubbles bursting one after another. The sell-off is exposing those swimming naked. It has revealed some unbelievably poor business and governance practices. And similar to the subprime crisis, it has uncovered the interconnections and opaque structures within the crypto house of cards. This is set to dampen enthusiasm in the belief that technology can free finance from scrutiny. The crash has served as a cautionary reminder that finance cannot be trustless and stable at the same time. Trust cannot be replaced by religious faith in an algorithm. It requires transparency, regulatory safeguards, and scrutiny. Does this mean that we are witnessing the endgame for cryptos? Probably not. People like to gamble on horse races, on football games, and many other events. And some investors will continue to gamble by taking speculative positions on crypto assets. Today, I will argue that we need to move rapidly from the debate on crypto assets, regulation, and taxation to decision and implementation. And to harness the possibilities of digital technologies, we must provide solid foundations for the broader digital finance ecosystem. This requires a risk-free digital settlement asset which only central bank money can provide. And I will elaborate on this. The philosophy behind cryptos is that digital technology can replace regulated intermediaries and avoid what has been called state intrusion. This is just an illusion. In fact, it is precisely the absence of regulation and public scrutiny that blinded investors to the risks involved, leading to the rise and subsequent fall of crypto assets. The risks associated with crypto finance stem from three fundamental flaws. The first structural flaw is that unbacked crypto assets, which form the bulk of the crypto market, as you can see from chart number 1, yes, thank you, do not offer any benefit to society. What do I mean by this? Unbacked crypto assets do not perform any socially or economically useful function. They are not used for retail or wholesale payments. They do not fund consumption or investment and do not help fuel production. As a form of investment, unbacked cryptos lack any intrinsic value. They have no underlying claim. There is neither an issuer who is accountable and liable, nor are they backed by collateral. They are notional instruments created using computing technology, which do not generate financial flows or use value for their holders. Their value cannot be estimated from future income discounted to the present, like for other real and financial assets. Unbacked crypto assets cannot help to diversify portfolios. Recent developments show that their value does not increase when income becomes more valuable to consumers, such as in periods of high inflation or low growth, portfolio theory. The price changes show increasing correlation with stock markets, as shown in chart number 2, but with much higher volatility. Many investors have suffered significant losses from the crypto collapse and cannot expect any compensation. There are no insurance schemes. In several instances, unbacked cryptos have shown to offer investors little, to put it mildly, little protection against IT and cyber risks. On the whole, it is very difficult to see a justification for the existence of unbacked crypto assets in the financial landscape. They are just speculative assets that investors buy with the sole objective of selling them on at a higher price. In fact, they are a gamble disguised as an investment asset. Millions of investors were lured by an illusory narrative of ever-rising crypto asset prices. Many invested without understanding what they were buying, and there is survey evidence showing this. In the website, in my speech in the website, you find reference to surveys which show that investors responded to the surveys telling to the interviewer very candidly they did not understand what they were buying. They bought it because somebody told them and they thought they would make money. Irrational enthusiasm prospered on self-fulfilling expectations. Like in a Ponzi scheme, such dynamics can only continue so long as a growing number of investors believe that prices will continue to increase, until the enthusiasm vanishes and the bubble bursts. The market value of crypto assets has shrunk from $2.5 trillion a year ago to less than $1 trillion today. This is the evolution of the market cap of the crypto finance universe. The price of Bitcoin, which is probably the best known unbacked crypto, has fallen by more than 70% from its peak, as you can see from this chart. The second structural flaw is the purported stability of stablecoins, which the entire crypto ecosystem has relied on to underpin trading in crypto assets. Although stablecoins represent only a small part of the crypto market, crypto trading using Tether, the largest stablecoin, accounts for close to half of all trading on crypto asset trading platforms, as shown in chart number 4. So, stablecoins are mostly used internally in the crypto universe to facilitate trades and probably to complete the arbitrages that make you make a lot of money. By the way, we heard somebody who was very happy when some investors default. I'm the other guy, the one who tries to avoid that somebody is going to default. So I'm sorry for you guys. Stablecoins appeal to users because it is claimed that unlike unbacked cryptos, they provide stability by having their value tied to a portfolio of so-called reserve assets. But the recent crypto crash has highlighted that without sound regulation, stablecoins are stable in name only. Digital innovation cannot, for example, build stable values on the basis of codes and mechanisms of cryptographic dependency. This was the key takeaway from the collapse of the stablecoin Terra USD, which lost its peg to the US dollar in May and has since been trading for 10 cents, as shown in this chart. This is the outcome of investment that some people did in this stablecoin. Overall, this scramble for stability and the shortcomings of stablecoins underscore the importance of a settlement asset that maintains its value under stress conditions, a risk-free asset. In the absence of such risk-free asset, in the absence of such digital anchor, which only digital central bank money can provide, stablecoins represent an overambitious attempt to create a risk-free digital asset backed by risky assets. The third structural weakness is the fact that crypto markets have incredibly high leverage and interconnections, which creates strong procyclical effects. Crypto exchanges allow investors to increase exposures by up to 125 times the initial investment. It's not a typo, 125 times the initial investment, as shown in the left panel of this chart. As a result, when shocks hit and deleveraging is needed, investors are forced to shed assets, putting strong downward pressure on prices, as shown in the right panel of this chart. These procyclical effects are exacerbated by the pervasive over-collateralization adopted in DeFi lending to compensate for the risks posed by anonymous borrowers. The fundamental flaws I just mentioned have led many to predict the demise of crypto assets. But these flaws alone are unlikely to spell the end of cryptos. Gambling is perhaps the second oldest profession in the world. Not the oldest, but probably the second oldest. It has been, there are very elaborate comments on this, which date back to the ancient Rome and ancient Greece. People have always gambled in different ways, rolling dice, betting on animals, or playing cards. And in the digital era, cryptos will continue to attract investors looking to gamble. We therefore need to mitigate the risks while harnessing the innovative potential of digital finance beyond cryptos. There are two elements to this. The first is to regulate crypto assets, ensuring that they do not benefit from preferential treatment compared with other assets. The recent failures of crypto entities do not seem to have had a material impact on the financial sector, but they have highlighted the immense potential for economic and social damage if we leave the cryptos unchecked. Regulatory efforts should primarily be directed at preventing the use of crypto assets to circumvent financial regulation. This should be coupled with measures to ensure that the risks of crypto assets are clear to all. Potential buyers should be fully aware of the risks they take when they buy cryptos. Gambling activities should be treated as such. The other task is to shield the mainstream financial system from crypto risks, notably by segregating any crypto-related activities of supervised intermediaries. The European Union regulation on markets in crypto assets, which was mentioned before, is leading the way in building a comprehensive framework to regulate cryptos and crypto asset service providers. It is crucial now that it enters into force as soon as possible. Looking ahead, the regulation of crypto activities will have to be adapted to the continuous evolution of risks. Given the time needed to design and apply new legislation, it is important to empower regulators and supervisors to keep pace with market and technological developments. The ECB is responsible for the European Central Bank is responsible for overseeing European payment systems, and we have already taken action in this field. The oversight framework for payment instruments, schemes, and arrangements we launched last year addresses the risks of crypto assets for payment systems. Authorities also need to address the significant social costs of crypto assets. The use of crypto assets for money laundering and terrorist financing, which is not a rare event, could be prevented by applying the standards set by the Financial Action Task Force. The other task is the taxation of crypto assets. In Europe, given the negative externalities that crypto activities can generate across multiple member states, the European Union should tax cross-border crypto issuers, investors, and service providers. Crypto assets with an excessive ecological footprint should be banned. You know that there are some unbacked cryptos that cause an enormous damage to the environment. Enormous. But regulation is not enough. To harness the opportunities offered by technological innovation, we need to give the broader digital finance ecosystem an anchor of stability in the form of a digital risk-free asset. Some commentators argue that adequate regulation would allow stablecoins to provide such a risk-free asset. This is a misconception. Stablecoins invest their reserve assets in market instruments, which inevitably exposes them to liquidity, credit, counterparty, and operational risks. Prudent investment policies can reduce, but not eliminate such risks. The riskiness of stablecoins will over time lead them to being traded at variable prices, making them unsuitable as risk-free assets. Risks could theoretically be eliminated by allowing full reserve or narrow stablecoins to hold their reserve assets entirely in the form of risk-free deposits at the central bank. But this would be tantamount to outsourcing the provision of central bank money. Translated, this is not possible. Threatening monetary sovereignty. Only central bank money can provide an anchor of stability in the form of risk-free assets. Central bank money is currently available for retail use only in physical form, banknotes, cash. But the digitalization of payments is eroding the role of cash. People prefer to pay digitally, and the world is becoming digital. If you buy your goods online, you cannot pay with cash. So people are using more and more digital means of payment. Central bank digital currencies would instead make public money, risk-free public money, available for digital retail payments and offer a digital risk-free common denominator among different forms of digital money. It would thus preserve the singleness of money and protect monetary sovereignty. The European Central Bank is working on a digital euro precisely for these reasons. But to preserve its crucial role, public money must also continue to be used as a settlement asset for wholesale financial transactions. The European Central Bank, we are exploring what would happen if new technologies were to be widely adopted by the financial industry. Whether such a scenario will materialize is uncertain, but we must be ready to respond if it does. Our response may include making central bank money available for wholesale transactions on one or more distributed ledger technology platforms, or creating a bridge between market DLT platforms and existing central bank infrastructures, which, unlike you heard before, is not old technology. It's a highly efficient technology that manages trades by all intermediaries in the euro area, in the US, in other major jurisdictions. Let me conclude. Crypto assets were portrayed as a generational phenomenon, promising to bring about radical change in how we pay, save, and invest. Instead, they have become the bubble of a generation. It turns out that crypto assets are not money. Many are just a new way of gambling. There is an urgent need globally for regulation to protect consumers from the risks of crypto assets, define minimum requirements for crypto firms' risk management and corporate governance, and reduce the run and contagion risks of stablecoins. We should tax crypto assets according to their social costs. But regulation will not turn risky instruments into safe money. Instead, a stable digital finance ecosystem requires well-supervised intermediaries and a risk-free digital settlement asset, which only digital central bank money can provide. Thank you for your attention. I look forward to your questions.